Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about what the effect of the Iran war will be on mortgage rates and whether it can make mortgage rates worse. Before we dive in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast. You look very Miami today.
Yes, I literally just got off stage and ran up here, Madam President, to make sure that I come on time for you because, yes, I'm in Miami. Wow, boy, a lot has happened. We're kind of talking about in the last part, like what are the variables, and the Iran situation is interesting to me now. Thinking what happened on Friday, to what happened on Sunday night, to what happened on Monday. So this is Monday. We're talking about it. Oil prices have not probably escalated as high as people thought. But on the bond market and mortgage side, the initial reaction was what people usually think. Money went into the bond market early on Sunday night trading, and then it kept on going higher and higher and higher. We were pretty much flat. But like we wrote in the article, escalation is the key to any of these situations. And unlike the bombing of the nuclear facilities, there's no talks of ending this anytime soon.
Right.
So because of that, because the 10-year yield got to a yearly low at 3.92, we saw a pretty good move higher. Now, mortgage rates went from 5.99% to 6.12, so it's nothing too dramatic. And the 10-year yield is still near, it's basically at the levels kind of it was not that long ago. But going out in the future, if this escalates into a bigger thing, and then it's going to be part of the marketplace for a while, because it wasn't like, hey, by the way, we're done, we're moving on. They're like, hey, listen, this is going to be here for a while, and all of this. And in that context, until you get a little bit more clarity, we have to deal with that. But it's also jobs week. And then on top of that, the ISM manufacturing, whatever, paid price index, like really blew up higher. A lot of that has to do with some of the tariffs on aluminum.
So I think clarity is hard to come by, right? We've heard different things at different times, even just from the president. But I think we can say that compared to what he did in Venezuela, where that was a pretty quick action, then we're out. He has said that he wants to regime change. At one point he said he thinks it's going to be a couple weeks. No one really knows. So are you surprised that it actually hasn't, that the market hasn't acted even more that things didn't go higher?
This area is not, of course, my wheelhouse, but I'm just giving my observation. I don't think the market is pricing in this being an escalating event because of what Iran can or can't do, and because of the midterms here. So, and again, while I'm talking, the 10-year yield is just at 4.05%. Mortgage rates are at 6.12%. Oil prices didn't get up to, let's say, WTI get $80 or $82. So I just don't think the market is fully believing yet that this is going to be an escalated event. But if this keeps on going off, see, Iran's taking a different approach. They're shooting their neighbors, right? It becomes more expensive if boats just don't want to go through the Strait of Hormuz, or the insurance rates go up. So this is a different tactic on both sides on Trump. And again, what was different about Trump this time around than the first one? Godzilla tariffs, right? Nobody thought they would do Godzilla tariffs. Now, going in and, bombing Iran like they have. The midterms are coming up, but, what if Trump just goes, hey, listen, I know I'm going to lose the midterms. I got to get as much in as I can before, things get harder for me. So we'll have to wait and see what happens. But that's the Iranian situation right now, and its impact on oil prices in the 10-year. I know a lot of people thought, okay, well, money goes into bonds and everything. We are working from the lowest levels of the year, and we had a hot inflation print on Friday, and on Monday morning, the ISM price paid index was very hot as well.
So I will say to listeners, Logan wrote about this as part of the housing market tracker over the weekend because, of course, we woke up on Saturday morning. We're like, okay, just what we talked about on the Friday podcast on the, what are the wild cards? It was like, okay, this is definitely a big one. So I would say, go there because he lays out sort of why he's thinking this way. But yeah, I think it's really interesting. And unfortunately, I feel like this could raise rates right when we were thinking this is going to be, a better start to spring.
But did it really raise rates in a big way? I mean, that's the thing. I don't know if it's a coincidence that, okay, now that, of course, I don't think it's, let's wait till the 10-year yield gets under 4%, then let's go, attack Iran. But I'm always looking on a technical side. I need the 10-year yield to break above 450. I mean, we were at much higher yields earlier in the year. So for now, it's actually a mild response considering the seriousness of the event. So I just don't see this being fully priced in yet, because to me, it's like the 10-year yield should be higher because not only of the event, the scale of the event, because the PPI inflation was hot, the jobless claims data was low, So I'm not fully convinced the market is buying in yet. But if I saw oil prices, not crude, but WTI get above $80, if I see the 10-year yield get back up to 430, but again, you're now dealing with variables between how much can Iran really take, how much does Trump really want to push this,
Right.
For the midterm. So it's just one of these X variable things that we have to deal with, and we'll take it one day at a time. But that wasn't the biggest story. I mean, of course, it was the biggest story, but it wasn't one of the. There were other storylines to talk about on Monday too.
Okay, well, let's talk about some of those, right? Because this is a week of a lot of economic data.
So we have jobs reports, we have Fed speeches, we have retail sales, but the prices paid on the ISM index really just blew up to the high side out
Okay,
there.
what does that mean? Maybe.
Basically, manufacturing's the prices they have to pay for the goods is elevated higher than what people were anticipating. Then you have the PPI inflation data that was super hot. So we're having 3% plus PCE inflation. That's what the Fed tracks. So now the question is, a lot of people say, well, if oil prices got to a certain level, it becomes disinflationary because it hits demand. We have to remember, as a percentage of income, we spend a lot less on oil like we used to. Like in the late 70s, like how does oil, adjusting to inflation, oil has to be like $450 to get those kind of levels. So we're obviously not there. And the oil response was big, but not as big as people think. So I just don't think we're fully pricing in this being an escalating event, considering the things that have happened. So, but that's the Iranian side. Now we have the economic data side, right? What if we have a jobs report that beats expectations? What if retail sales picks up? Stuff like that to me actually matters more because I'm sitting here the last time I saw the 10-year yield is 4.05%. We're pretty much at multi-year lows out here. And again, I hold that Hodor line at 380 for a reason, but it really is going to get interesting to see if Fed governors start to make comments on this because they've got prices paid going up. They have PPI inflation going up, and the energy portion, they could maybe say until we get some clarity, we're not sure. But that's the Fed doesn't really manage that part of the economy in a sense. So interesting week. Interesting. I mean, this whole week's going to be kind of a buckle up, but I still don't think the market is pricing in the full escalating of this going on, even though Trump has said, I'm going to be here for weeks until they give up. And the Iranians are shooting their neighbors left and right. So definitely a weekend to take notice.
So, what do you think? If you're the Federal Reserve, do any of these factors move what you were going to do?
If I were them, I would just I would not make comments about the Iranian thing at this point. If you want to talk about PPI inflation or prices paid, go, but don't kind of get into that. Midterms are coming up. Remember the whole Trinity impact. The whole Trinity
Right.
impact was that, but we have to look at this in relative terms. Oil prices were 120.22 during Ukraine. It was like 72 last time I saw. The 10-year yield was at 5% at one point in 2023. Mortgage rates were at 8%. We're near 4% with 6.12%. So relative terms, not that big of a deal yet. But going out, is this like they're going to just go for it as much as they can in a very short amount of time and then clear it up a little bit later? But there's more at play here with the inflation data with some Fed governors. Again, we're supposedly going to have 15% tariffs now, and people can see that the prices being paid on some of these goods is keeping things sticky. So it's 24.
It is. It really is.
It
Okay,
really
like
is 24.
this weekend, I was like, that was the right analogy. I hate to say it because nobody needs that, but and what I mean by that is nobody needs the kind of events that happen in 24. But yeah, this is crazy. So anything else, before you were putting in all this about the Iran war, what were you looking at in the tracker that was catching your eye?
The tracker was good. Now, the tracker had a big inventory decline and a big new listings decline. I would just say that there's a seasonal flow of inventory and new listings data, and I chalk it up to that. And I think we're about to start the March push on inventory. Weekly pending sales positive. Price cut percentage is still down 1.25%, but it's about to do its upward slope that we see on the seasonal increases. So the tracker looked good on that side. And of course, rates got below 6%. So we'll see how this kind of plays itself out on some of the weekly data going out. But if you just like closed your eyes and you just thought to yourself, the 10-year yield's at 4.05% and mortgage rates are 6.12%, it's not a big deal whatsoever at all. That's like the low levels of the multi-year low levels of those two things. But I think as long as this Iran situation goes on, you just don't know how the market's going to react or going out in the future. Is it if it escalation, right? Like the nuclear bombing facilities was one and done, out, done, finished, gone. So far, that's not been the case. But I just to me, it just looks like if this thing can get worse, there's a lot more pricing that can be impacted. But for now, considering the severity of it, considering the inflation data, the jobs data, wow, not bad actually. When you look at it in that context.
So are we going to have a typical Jobs Friday report this week?
Jobs will be fine. I don't think the job openings is this week, but we'll have the ADP, we'll have the weekly jobless claims and the BLS report. So we have retail sales as well. Of course, I'd like everything to get back onto the economic side of things because I think that's a value for. But I mean, if you just sat there and thought about for a second that you could have very low jobless claims, 3% plus inflation report coming next month because PPI and prices paid up and we're war with Iran. Boy, if you're telling me the 10-year yield's at 4.05 and the mortgage rate's near 6%, you're like, a lot of people wouldn't take that. Bet, and I totally understand, but we really need to keep an eye on the Iran situation, but really focus on the economic data because the economic data is going to be the big driver. Everything, the situation in Iran will eventually find a solution or an ending, but it's just a big week. We got a lot of things going on.
And so tomorrow, so we're recording this on Monday. Tuesday is primary day, as you said. The midterms are here. No, we're not electing someone tomorrow, but it will be a bellwether of who is what part of the ideological spectrum is seeing momentum and not, and that might influence the White House.
It is. It's just this move from Trump is as aggressive as the Godzilla tariffs were. Right. So this wasn't like the nuclear facility bombing was a big move, but it was like one and done. That's it. But this was legit. I mean, this is not some, flyby event. Of course, this week we're going to get existing home sales. The NAR is bringing that out there and just to kind of reemphasize, this is the last report, I believe, that you're going to see the snow data into it, because our weekly data is picking up there. And just a review for everyone, the housing market shifted mid-June. The housing data started to get better all the way up until December. December had a 9-month sales. We refused to write the tracker for the last 2 weeks of the year and the first week, just because we knew that when you're working from an elevated level and you have Christmas and New Year's in the middle of the week, that you need to be full throttle with everything. That wasn't going to be full throttle. So that decline that we saw the initial decline, which we said everyone's going to overplay this, they did, right? And then the data rebounded very aggressively, and then the snow happened, and we're just the last 2 weeks we're seeing the snow data kind of filter itself off. So our weekly pending sales looks out 30 to 60 days out there. So last existing home sales report. After that, I think we're free and clear on a lot of things. We just go back to the normal reports on that side.
Logan, thank you so much for jumping in this weekend and writing up like what the Iran war meant for mortgage rates. We will be keeping close eye on this. So listeners, if something happens, check housingwire.com, because Logan will have another report on this. But we are watching it closely when it comes to what is it going to do for the housing market.
And just to refocus everyone. Imagine 7 months ago, if somebody told you inflation is on the hotter side, we just bombed Iran and took out a lot of their leadership. The prices paid on manufacturing data on this is blowing up higher, and we're here with a 4.05% 10-year yield and 6.12% mortgage rate. Spreads, Sarah Wheeler, mortgage spreads, the unsung hero of last year and the unsung hero of this year, because mortgage rates would easily be, we could be talking about 7.5% mortgage rates today if the spreads didn't improve from the worst levels of 2023. So it's a lot to go over. It's crazy time, but that's our job, to try to make sense of it all.
That is our job. Logan, thank you so much. I will talk to you again soon.